Introduction to Investment Philosophy. Do you need an investment philosophy? The answer is simple. In the absence of an investment philosophy, you will tend to shift from strategy to strategy simply based on a strong sales pitch from a proponent or perceived recent success. There are 3 negative consequences for your portfolio. 1. Lacking a rudder or core set of beliefs, you'll be easy prey for charlatans and pretenders, with each one claiming to have found the magic strategy that beats the market. 2. As you switch from strategy to strategy, you will have to change your portfolio, resulting in high transaction costs, and you will pay more in taxes. 3. While there may be strategies that do work for some investors, they may not be appropriate for you, given your objectives, risk aversion, and personal characteristics. In addition to having a portfolio that underperforms the market, you are likely to find yourself with an ulcer or worse. The big picture of investing. To see where the different investment philosophies fit into investing, let us begin by looking at the process of creating an investment portfolio. 1. The process always starts with the investor and understanding their needs and preferences. For a portfolio manager, the most significant part of the investment process is understanding the needs, the tax status, and, most importantly, the risk preferences. 2. The next part of the process is the actual construction of the portfolio, which we divide into 3 subparts. The first of these is the decision on how to allocate the portfolio across different asset classes, defined broadly as equities, fixed income securities, and real assets, such as real estate, commodities, and other assets. The second component is the asset selection decision, where individual assets are chosen within each asset class to make up the portfolio. The final component is execution, where the portfolio is actually put together. 3. The final part of the process, and often the most painful one for professional money managers, is performance evaluation. Investing is, after all, focused on one objective and one objective alone, which is to make the most money you can, given your particular risk preferences. Market timing versus asset selection. The broadest categorization of investment philosophies is by whether they are based on timing overall markets or finding individual assets that are mispriced. The first set of philosophies can be categorized as market timing philosophies, while the second can be viewed as security selection philosophies. At a general level, investment philosophies can also be categorized as activist or passive strategies. Note that activist investing is not the same as active investing. In a passive strategy, you invest in a stock or company and wait for your investment to pay off. In an activist strategy, you invest in a company and then try to change the way the company is run to make it more valuable. Different investment philosophies require different time horizons. A philosophy based on the assumption that markets overreact to new information may generate short-term strategies. Developing an investment philosophy. If every investor needs an investment philosophy, what is the process that you go through to come up with such a philosophy? While this entire book is about the process, in this section we can lay out the 3 steps involved. Step 1. Understand the fundamentals of risk and valuation. Before you embark on the journey of finding an investment philosophy, you need to get your financial toolkit ready. At the minimum, you should understand 1. How to measure the risk in an investment and relate it to expected returns. 2. How to value an asset, whether it is a bond, stock, real estate holding, or business. 3. What the ingredients of trading costs are, and the trade-off between the speed of trading and the cost of trading. Step 2. Develop a point of view about how markets work and where they might break down. Every investment philosophy is grounded in a point of view about human behavior and irrationality. At the same time, though, you should keep in mind 3 caveats about this research. 1. Since they are based on the past, they represent a look in the rearview mirror. Strategies that earned substantial returns in the past may no longer be viable strategies. 2. Much of the research is based on constructing hypothetical portfolios, where you buy and sell stocks at historical prices and little or no attention is paid to transaction costs. 3. A test of an investment strategy is almost always a joint test of both the strategy and a model for risk. To the extent that we mismeasure risk or ignore a key component of risk, it is entirely possible that the higher returns are just a reward for the greater risk associated with low price-to-book value stocks. Step 3. Find the philosophy that provides the best fit for you. Prerequisites for success. Prerequisites for success. 1. Your risk aversion. 2. The size of your portfolio. 3. Your time horizon. 4. Your tax status. Conclusion. To be a successful investor, not only do you have to consider the evidence from markets, but you also have to examine your own strengths and weaknesses to come up with an investment philosophy that best fits you. Investors without core beliefs tend to strategy, drawn by the anecdotal evidence or recent successes, creating transaction costs and